Hello, this is Jordan. This is being recorded on Tuesday, January 16th, 2024. Thank you so much for joining me today. In this video, just going to do a very quick macro update because this recession signal is flashing yellow. I wouldn't say it's flashing red, but it's flashing yellow. And we'll get into that with this single chart. And that signal is the steepening of the yield curve. Now, we know that when the yield curve steepens, and it goes above zero, and it does so in a more vertical fashion, that would be code red for a recession. That's a red light for a recession, a red light signal. But it's at yellow right now. So let's get into it. So a lot of things here. We have the yield curve here, and this horizontal line, this is zero. So we see that when it goes above zero in this kind of vertical fashion, that is a recession signal. Here's the double dip. I pointed this out. This wasn't quite a recession signal, but I wanted to put that there anyway because there were rate cuts. But here's where we are right now. This doesn't have today's data updated yet, but I believe it's at minus 0.17 or even a hair below that at minus 0.16. So this is yellow because it's getting ready to go above zero. Now, to be a real recession signal in code red, it's got to be like a vertical move. If it meanders around it like that, that's not really a recession signal like, we saw it kind of do here or here. It meanders around zero. It wasn't until this point when there was a recession. So that's important to note. And, typically, you get this steepening or rising, and that typically coincides with rate cuts. That leads to rate cuts, we can see. And so the yield curve is the difference between the 10-year yield and the 2-year yield. 2-year yield is a proxy for Fed funds. So when this is steepening, in most cases, it means that the 2-year and short-term interest rates, they're plunging because there's economic worries, and it's going to lead to imminent rate cuts, basically. So steepening leads to recession worries, imminent rate cuts. Now, you can also get an inflationary steepening, but that would be for another video. That's when they're both going up, but the 10-year is going up more than the 2-year, and it gets it uninverts and steepens that way. But again, that's topic for another video. So, when you get this steepening, what typically happens to the stock market? Now, gold bugs and gold bulls, they'll just look at these two. You when you're looking at data and looking at history, you really have to look at a long impact of history. You have to look at multiple cycles. So, these two are famous. Steepening, market down over 50% both times. So we know that was super bullish for gold. But if we're looking back to periods before that, the double dip in the 80s, you have the steepening here, this steepening, S&P was down 18% this time. Here it was down 24%, and it was down more. I just measured it from here, which is a lower high than, from here it would have been, probably 28%. But my point is, so you get this steepening, and then this was 1990, so steepening here, 20% decline in the stock market. So if we get a real steepening, a real vertical move above zero, that means rate cuts are coming. That's bearish for the stock market, really bullish for precious metals. And, even here, gold was in a secular bear. Gold was coming off of this, epic bubble or even mania. And so even when you had this steepening, you did have little rallies in gold. They were oversold bounces when gold was coming, basically crashing. But it is bullish for gold. But you have to look at the entire context. Now here, the late 80s, 1990, gold was still in a secular bear, but you started to get the steepening here. Gold went up a little bit. It went up a little bit more when you got the the real steepening above zero. Gold against the stock market. So you did have a little move there. But we're setting up, because we know that precious metals have been a secular bear for more than a decade. And I think, gold against the S&P here, I mean, this is not the best action, so I'm a little worried there could be a decline here before it turns up. But this is not too much different from what was happening here. I mean, you could see this kind of a double bottom or this rounded bottom. I mean, this is a little different because there was already a secular bull market in gold. There was a secular uptrend. But again, I mean, this could be similar to what's going on here. So this is the key signal for gold and precious metals as a whole. You get this steepening or this vertical move in the yield curve above zero, something like that. That's going to coincide with stock market dropping, Fed being forced to cut, gold going like that, obviously, and then this turning up as well. So, and to sum it all up, the signal is on yellow. It's not on red yet, because red is when these second lines, I mean, that's red when it's moving above zero in a vertical fashion. That's code red. We're on yellow right now because this is where it is, minus 0.17 to be exact with where we are today. But it's getting closer. It's getting closer. So this is code yellow. So there you go. That's today's video. Let me know what you think in the comments. And I'll talk to you guys again in the next video. I'm thinking about doing a video, putting together a 2024 Outlook video. So let me know what you think. Leave a comment. Thank you so much for tuning in. Talk to you guys again in the next video.